Welcome back. It's no surprise for you to learn that I think the stock market movements this year have been crazy. But what does Investor Mutual's Senior Portfolio Manager and Head of Research Hugh Giddy believe is happening, and how long will it keep happening in this annoyingly negative way? I spoke with Hugh a short time ago. Hugh, thanks for joining us.
You're welcome.
Now, before we start talking about this crazy start to the year for the stock market, the market was up today, Wall Street was down. I think early in the week, Wall Street was up and we were down. We seem to be a little bit decoupled at the moment. How do you read, say, for example, today's movement on the stock market?
Day-to-day moves are very hard to read. To be honest, I'm not exactly sure why we were up. Sometimes our market's anticipating the US rather than following the US. Maybe you could say we do have quite a different composition to Wall Street. Wall Street's got a lot more tech and biotech, and we have much more resources and energy, and as well a very big financial sector. So that would sometimes explain market differences. Our market has, as you know, been sold off quite hard, and investors are probably looking to invest whenever they perceive an opportunity, hoping that they can pick the bottom, and so you'll get patches of buying interest that exceed the selling pressure. And that's obviously what happened today.
Yeah. So Hugh, do you think we're still in a buy the dip situation? Because I am noticing that we don't go very far beyond 5,000, and a lot of buyer interest, resurrects itself. But there are some people out there saying, "Oh no, this is not a buy the dip situation." What's your feeling?
I really, to be honest, I focus on stocks more than the market. Our market is so lopsided with, over 40% of the market is really financials. The resource segment has shrunk a lot, but is another big sector that you have to think, well, the market's really, 50 to 60% in two very specific sectors. So rather than looking at where the market is and index level, I just look at stocks and, are there opportunities and so forth.
Yeah.
I mean, broadly speaking, it must be said this feels a little bit different to other sell-offs we've had, and so maybe buy the dip won't work. In the US previously, when we've had sell-offs like we've had recently, we've had quite rapid, sharp recoveries, and on this occasion the market sold off, and we've had some rallies, but the rallies have gone the next day, with another sell-off. So it's behaving a little bit differently.
Okay, but given the fact that I know that your speciality is to look for quality companies.
Indeed.
But the thing is this: in 2008, it didn't matter what quality company you went for. When the market really, to put it pretty crudely, crapped itself, even your great judgment would have, you would have looked like a nincompoop until the market turned around. So you can't be totally ignorant of what the market might potentially do. So are you worried that this might be a pre-crash situation? Because there are some people out there who are peddling that kind of view. What's your reaction? Even though it's not important to you, it's something you can't ignore. Do you think we're in a pre-crash situation?
That's a hard call to make. There are people out there peddling possible crashes almost all the time. I do believe that the world is not in a state of great financial stability. We've got a lot of leverage. There's more leverage in the world than there was in 2007, pre-GFC. The composition of that leverage has shifted a bit. You've got a lot more leverage in the emerging markets, which is rather dangerous. You've got a lot more leverage for government entities. and a little bit of a reduction in corporate and household leverage depending on the country. In Australia, private sector leverage has risen because we've had another housing boom / bubble. And that's a dangerous thing. And there are lots of worrying signs in the basic structure of credit and the amount of debt in the economy and so forth. And those, you don't normally get a crash without those things, but those things in and of themselves do not ensure a crash will happen. But you know, we have, speaking of crashes, we've actually had plenty of crashes, just not in the major stock indices. We've had a crash in the Shanghai stock market, we've had a crash in the oil price, we had a crash in the iron ore price. The last few years have actually witnessed a lot of crashes in various asset classes. You've had a crash in the Russian ruble. It's the sort of the last man standing is really the stock market, and that that's been interesting in that we haven't actually had that much economic growth, and we haven't got what I would consider a favorable growth outlook, and yet the US stock market until recently has been hitting new highs.
Yep.
And that to me suggests that the sell-off we've had is actually rational. It's not irrational selling off because the market had got ahead of itself in the US. Whether that will continue or not, it's hard to make that call. But I understand the arguments of the people who are calling for a crash, because there is definitely fundamental weakness in the underbelly of the financial system, because we do have too much debt, and we don't really have a strong enough economy to support all that debt. And so the ingredients are there for a crash, but to call for a crash, I think, is something that I can't actually do. Well, I can, but I don't know if it's useful.
Okay, now that's good. I'm glad you're not pushing that one. How important is the macroeconomic setting when it comes to selecting a company that you like? For example, the global economic setting, the national economic setting, how important is it for you?
Well, I believe the global economy and the national economy is important, because if you don't understand the environment we're in, you could be lured into believing the hype that always companies, shares in general. Yeah. There's always hype around companies and what could happen and the money that could be made and so forth, and it's wonderful. I mean, there are a lot of optimists out there, optimistic CEOs who promise the world, optimistic stockbrokers who want you to buy shares and so forth, and you've just got to cut through to what's really going on. And what's really going on in the world today is very little overall growth. It's a very weak economic environment. You've got governments with deficits that are very stretched. You've got an aging population that's spending less than before. You've got credit at a very high level, and so that credit growth is very low, and credit growth tends to drive spending and so forth, and growth. And if you don't have credit growth, then spending growth is normally quite muted. So if you've got this low growth environment, then you shouldn't believe that it's going to be easy for companies, and that, I think, leads you to be very selective with companies. And I think that even though they've tended to have quite a good run, you tend to favor companies that don't need a tailwind from good economic growth, because good economic growth is not really in abundance. And that sort of played into our philosophy of buying quality companies that are sustainable and defensive and don't require help from things that are beyond the company's control, like the economic cycle. We prefer a company that doesn't need that sort of outside assistance, but more can generate organic growth, because it's say a healthcare company with great innovation, or always benefiting from something that's very certain, like an aging population, rather than saying, oh, let's buy this company because we think the world economy is going to get better, and therefore the iron ore price will rise or the steel price will rise, which to my mind is not very likely.
So what kind of companies at the moment fit the bill? given that your description of the kind of companies that you like?
Well, I'd still be overweight healthcare. I'm selective within that. I prefer CSL and ResMed to Cochlear, for example, or Primary, just because I look at it on a stock-by-stock basis. But those companies, although they've had a good run, have organic growth, and they're generating good cash flow, and they've got great balance sheets. So I look at them as stocks. I still like basic simple companies like Tattersalls, which again, it's had a decent run, but Tattersalls' main business is lotteries. I don't think lotteries are particularly sensitive to the economic cycle because it's a low value purchase. Most people are going to do it fairly regularly in the hope of enriching themselves. They want to flutter, but it's not it doesn't require people to be super rich to play the lottery as it may do to play at the casino. You've seen how much, for example, Macau is suffering on the back of economic weakness in China. So saying very defensive, companies with a competitive advantage. Lotteries have a distinct competitive advantage because they're monopolies. Tats has licenses in New South Wales, Queensland, and so on to run those lotteries for an extended period of time. And they're pretty predictable in the earnings and cash flows that they will generate. And so, I'm looking for those sustainable defensive cash flows. And sure, if we do get a big sell-off or crash, every company is going to get a bit of selling pressure. But the ones that get the most selling pressure will be the ones that don't have a solid base of cash flows and earnings, the ones that are more speculatively priced because people are hoping for better times ahead rather than just trusting that the status quo of the economy will be maintained, roughly speaking.
But Hugh, is there a company you're holding that does have those defensive qualities but also you think has a fair bit of capital gain upside?
What's my tip for the day? Oh dear. There's one I really like, but it's not ideal for Australian investors, and it's a New Zealand company. It is listed in Australia, and that is Chorus, which is building a fibre network, telecommunications, optical fibre network in New Zealand. They have the contract to build for most of the country, a little bit like the NBN in Australia, but it's most of the country. It's not a monopoly, but anyway, and then once that build out is done, and that's obviously quite capital intensive, then they will generate very good cash flows and should be able to pay good dividends. There has been some regulatory uncertainty that has been sorted out quite recently in Chorus's favour, actually, relative to the draft decision, and that caused a pop in the share price. But I still think there's further upside because once the network's built out and people move from copper to broadband, I think the cash flows will be quite good, and the multiple, the valuation on those cash flows is quite low. It's in the low teens, and it's sort of like an infrastructure play. If you look at infrastructure plays in Australia, like Transurban or Sydney Airport, the multiples are in the 20s and beyond. So that's an idea. It's a little bit left field. But that one definitely I find quite interesting, even though it's gone up.
I'm glad I've squeezed one out of you, Hugh. Thanks for joining. Thanks for joining us on the show.
You're very welcome. Thanks, Peter.
So that's Hugh Giddy from Investors Mutual. So thanks for joining us on the show. It's been great to be back. Don't forget, Best of Switzer over the weekend, the Sky News Money. And also on Saturday morning, try Googling Weekend Switzer. We're doing some interesting stuff on the weekend. We've spotlighted people like Katie Page and Harry Triggerboff recently. And I also did a little piece on explaining that movie, The Big Short. So that's Weekend Switzer on Saturday mornings. Thanks for joining us. See you on Monday.